Hello and welcome to this month's edition of the Unio Market Update. My name is Ger Fitzgerald and I'm joined by my colleague Alex Kinsella. Alex, Happy New Year to you.
And many happy returns, Ger.
Right, very good. Let's get straight in. Equity returns for 2023 finished the year on a very strong note.
They certainly did. As the chart shows here, you can see that throughout most of the year, markets have been relatively strong. They took a bit of a dip in Q3, but entering Q4, and particularly November and December, we had really strong returns. And the reason for that was the change from rates staying higher for longer to the perception that terminal rates had been achieved, and we're likely to see a fall in rates sometime next year. Now, when that will occur is in 2024 is a bit debatable. Why it's going to occur is probably more important with regards to markets and how that gets priced into markets. So if it's the growth slows below inflation rates, that's likely not very good for equities, but it'll prove very supportive for bonds. So I think the focus on inflation is a real key area for next year, Ger.
Absolutely. And look, we can see here from headline Eurozone inflation as charted in the purple line that the central bank policy, and namely the policy by the European Central Bank, has worked. Okay, they've, I suppose, had to raise interest rates in an effort to I suppose, trim or taper down in headline inflation. This has come true, and we're looking at headline inflation currently trending at in the order of about 2.9%. Underneath the bonnet, we can see some of those contributors now have actually become deflationary, the likes of energy in particular, which is actually one of the primary instigators of that increased inflation back in 21-22. So really, I suppose, the job that central banks had to bring down that headline inflation number and get it to that sweet spot of averaging around 2%, certainly they're going in the right direction. There is a little bit of a gap, a little bit of room to travel. And even if we're looking some of the contributors like services inflation is still trending at 4%, food inflation is still trending at 6.9%. So I suppose of those factors of headline inflation, yes, it's coming down, but there's still a little bit of a room to go. And then if we bring this forward into 2024 and looking beyond, we can see that from a market perspective, the interest rates now on government bonds and others are starting to waver as the market perception as to how soon central banks will cut interest rates moves on the back of, I suppose, the emerging information. We've seen quite a level of volatility in the likes of a 10-year German bond, for example, and over the last number of days, we've seen in the order of 10 to 20 basis points of a move in that 10-year German bond, which is pretty significant for a day-on-day movement. I suppose bringing this forward a little bit more and thinking about debt levels, one of the other items that we're cognizant of going into 2024 is global debt levels, and I suppose looking at them in conjunction with global GDP. And really, we've seen over the last number of years since 2009, those debt levels versus, I suppose, headline GDP have increased materially. Now we're certainly at a good point where central banks can look at cutting interest rates, and I suppose the cost of servicing that debt. But nonetheless, we are at an elevated level that we need to keep an eye on over the course of the year. More pressing and more prominent in the shorter term of this year, Alex, though, I would say, is the more political items that are going to impact markets over the course of this year.
Absolutely, Ger, and geopolitics is going to be ever present this year, not least in the fact that I think half the world's population are voting over the next 12 months. There's obviously going to be some more significant areas than others, but probably the most relevant is going to be November, whenever the US has its presidential election. But there's going to be ups and downs and quite a bit of volatility due to geopolitical and elections during the year. I think more focusing on the near term, the corporate earnings results that have kicked off this season and this month are going to be really informative. It's going to provide a test of investors' belief that the US economy can avoid recession as those inflation rates come down. I think in general we have quite a positive backdrop in that terminal rates have been achieved, and if we see a continuation of this strong economic growth story coupled with the impact of reduced capital costs, that's likely going to result in strong earnings for corporates. So as I said, it's going to be quite informative, and it's really going to potentially drive markets on as we start the year.
Very good. And I guess this is something that we come back to over the course of February, in particular when we're looking at, I suppose, the outcome of those earnings results. So we might leave it there for this month. Thank you very much for taking the time to listen to both Alex and I. Alex, thanks very much, and we look forward to speaking with you again next month.
Thanks, Ger.